There's no question about it. It's Microsoft, but they just do too many things, and you can't do everything. You can't do everything. I mean, I just said. All right, so let's go back, and I'm assuming you see my screen right now, right? Okay, so as an overview, this week we're going to distinguish between elements of the four financial statements. We're going to describe the steps to produce financial statements. So it's basically, if you watched my videos, you have all this information. I'm not going to replay the videos because that's crazy. I mean, we don't need to do that again. But if you watch my videos, you're going to get a lot of information about the four statements, right? So you should have that, right? And then this week, you're going to do the quiz, the video lecture, the connect assignments, and the live classroom. It's right now. And then we're going to talk about the financial statements, how you produce them, how you develop them. So going back, okay. I'm just in the chat. Could you let me know? Oh, I got you. You can't hear anything. How about you? How about you, Angelia? Could you hear me? Hello? Make sure you can hear me. Can you hear me? Because I have my mic on now. Can you hear me now, Abigail? Okay, you can hear me. Good. Abigail, could you hear me now, Abigail? Because it could be something on your end. And Angelia, do you also see my screen when I go back to the screen? Okay, great. Okay, Abigail's typing. I just want to make sure she's okay. All right, so let's go back. Let's just make sure. I think something on my. Okay, we'll try to fix it if you can. But you also have a transcript, all right, and another one from Abigail. Let's see. Okay, you have the excellent, good job. So, so you have these four. We have the video. I'm not going to play the video lecture again, but the live class is here. So let's talk about. You're going to apply this, right? For this assignment, you're going to review Target's annual report. Public companies will prepare reports annually on their operations. The annual report shares photos with shareholders, reviews the year's operations, make forecasts, provides financial information. And you can find this either in the Edgar site with the SEC, or just go right to Target and look up investor relations. So everything is always going to be there. And you're an intern at a bank and you need a basic understanding of financial information to carry out your internship duties. To show you understand basic financial statements, your supervising manager asks you to write a short report explaining specific items below. FYI, Target uses these terms for the financial statements. Consolidated statements of operations is your income statement. Consolidated statement of financial position is your balance sheet. Right? They just call it something different. Why they don't just call it income statement, balance sheet? You know, sometimes I shake my head. It's almost like they want to confuse people. And of course, the statement of cash flows. So you download their annual report, or you can use Merchant Online and use complete sentences, double space your report. Your report should be 5 paragraphs, including a brief introduction. Report requested information from the 3 paragraphs below. Include citations in APA format. So in the first paragraph, you start at about page 38, use 2021 numbers, using the table, record the total revenue, operating income, and net earnings for 2021, using sentences. Explain what these numbers mean and the difference between these terms. Are the numbers in thousands or millions of dollars? Well, you can imagine it's going to be millions. How many zeros would you add if you were to write out the numbers? That's why they do it in million. They say it in millions, but they don't express it as full millions because it would look ridiculous on a balance sheet. They tell you it's in millions, and that's how you have to read it. Give one example by writing out total revenue, including the required number of zeros. So what they're trying to teach you here is how to read an income statement. And most companies are going to have millions and millions and maybe perhaps billions of dollars of balance sheet information, right? Like they've got a company like Apple, where it's almost a $1 trillion company, which is 1,000 billions. I think it is a $1 trillion company. So in companies like that, you're not going to put out $1 trillion. The statements would look unwieldy. It would be hard to read them. You have all these zeros. So what they do is they cut the zeros off and they tell you they're reporting it in millions or tens of millions or whatever. And so do the same thing here. Just express it the way they taught you. So this way you know how to read a balance sheet. You know how to read an income statement. What are the amounts for total assets, total liabilities? You just add them. You follow where it's total liabilities. You follow where it's total assets and total shareholders investment. Present the information on a table using sentences to find the terms. It's not difficult. Just go to the statements and do that. And the third paragraph below the financial statements is a summary of accounting policies. In which country does Target generate most of its revenue? You read the policies, right? How does Target use estimates? When did fiscal year end for Target? Give one specific example of how an external stakeholder can see the information you have reported. Your example could be specific to the line item of the total statement information, and then do everything double spaced in APA, okay? So going back to our classroom, if you see this, I think I gave it to you. Let's see. Let's go back to module 2. I don't know if I put it here and I put it in the announcements. It's in the announcements. So if you go to our announcements, this thing, so annoying. You go into the announcements, and you'll see when you click on it, there's your interactive spreadsheet. So that's my information. That's all my information, along with the videos, that you're going to need or that you should watch that'll explain everything. It'll help you to understand everything. So I would definitely do that. Matter of fact, I'm going to copy that, and we'll get back to that in a minute. Now here, you could just download the Target information, okay? You can just download it. I'm going to open that in a minute. So there's Target's 2021 financial statement. But before we do that, let me go back to our classroom for a minute. And I'm going to go to content. And I'm going to go to this week's work. I think, here it is, my accounting videos. I gave it to you. So it's all here. It's all here. Watch the videos. I'm not going to play them for you today, but watch the videos, all right? Watch the videos. Matter of fact, I'm going to put it right here with module 2. It's crazy. I'm getting dizzy here. It's going to be right in front of module 2, okay? And you can watch these videos. And then I think we can also put the interactive spreadsheet here. But let's do that. Let's do that. Create document, and Professor Strafacci's. This will help you. Interactive spreadsheet. And the key word this week, and don't stop. I'm going to give you the keyword right now, but don't like just close this thing off, because then you're doing yourself a disservice. I don't think you would. But the key word this week is, there are 2 words: balance sheet. Balance sheet. All right, balance sheet is the key word. And here's my interactive spreadsheet. And why do I call it interactive? I'm going to make you view it and download so you can put it in a file for you one day and you can use it later. Is because what it does, that should be enough, right? I want to make it visible. What it does is you can actually call it up and see with Excel how the numbers flow through. So it's really a good thing to have. It's something you should definitely utilize. Okay, so let's go back to the Target thing. Okay, I gave you the annual report. You don't even have to go look for it. So here are your financial highlights, and give me a general thing. I mean, if it's not perfect, I'm not going to lose my mind over it, but I have to see that you understand what you're looking at. There's your operating income, right? So it's in millions, right? So even though it looks like 8946, It's 8,946,000,000. Okay, this would be their total revenue. It's 100. I think that's 100. I'm going blind. I'm getting older. $100 billion, right? Because you have to make this in millions. Net earnings after they made 88 on 100 billion in revenue, they have operating income of 8.9 billion. So they got about 8-9% operating margin. That's how you read that. That's how you read it. And their revenue went up 13%, but their operating income grew 36%, and their 5-year is 13%. So that's a good sign for now, even though it's only 8%, don't forget they paid off everybody. They paid their accounts payable, they paid their accounts receivable. They've done it all, right? They paid their employees, they paid themselves, the shareholders got dividends, presumably. So right there, you get a sense that, Target is doing well. And here's something you want to notice is that their revenue, their operating income, their profits from operations, not from all the other stuff that goes on in the company, like the sales of assets or accounting, sometimes some types of accounting. With all that happening, Target in these years were growing revenues, which is a good sign. I don't know how it's doing right now in 2024. I haven't looked at the stock in a while, and we'll do that in a minute. But that's good news for them, right? And then their net earnings it's growing incredibly. So that's something you may want to address, right? So of the 8% operating income, their net earnings come out to 6, because once you got operating income, then the rest just becomes small expenses. And then EPS is not in millions, obviously. It's per share. So the EPS went from 864 to 1410. So this is really good news for this company. And there's their total sales of 611 million, right? 104. So that's a big number. It's a big number. It's $104 billion. And, they sell a lot of stuff. I mean, they really do. And this is how it breaks down. Beauty and household, 26%. Food and beverage, 20%. We know now Walmart has become one of the biggest food and beverage sellers in the world. 19% home furnishing. 18%, whatever hardlines is, I have no idea. 17%, I guess hardlines might be, I don't know what that is. What are hardlines? Let's see. Appliances, okay, electronics, furniture, housewares. I tell you, the computer is amazing. Okay, so that's hardlines. And this is your letter to shareholders, so you could read what this guy has to say. They're doing well, obviously, in terms of this year. Right? They're doing well. They're not doing poorly. Right? I mean, you could just see their locations grew. They've opened up new stores. They invest in their global team. I mean, for somehow during these years, we expect investments like the ones I've mentioned to keep us growing faster in the market years to come. To drive mid-single-digit growth in total revenue and operating expense and high single-digit growth in adjusted earnings, we've also raised our expectations. So they grew sales. They're staying focused on families, on delivering small doses of everyday joy and providing both the items families need and those they want. That's contributed something distinctive to the millions of people we serve. So they're focusing on family growth is what this guy is basically saying. They have pickup and drive up. That was because 2021 was during COVID, right? And we received highly popular and productive additions like Ulta Beauty, Disney, Apple, Levi's. So they're giving you a clue as to how they're making money. And then you could see that sales were 104 billion, 92 billion. It's in millions, right? 104. Oh no, millions. I'm sorry. 100. Is that right? Yeah, 104 million. 92 million in 2000, 77 million. So I'm sorry, it's in millions. And then other revenue is very small. It must be from like investments they made. And then the cost of goods sold was 74 million. So it cost them 74 million to buy the goods. They sold them at 104. This is a typical retail company. Their SG&A, which is the people who run the company and sell and work in the stores, it cost them that was 19.7 billion. And then they take this a non-cash expense depreciation. So even though it shows up as an expense, it's non-cash. So while the operating income is 8.9 million, hold on a minute, is 8946. You have to add back 2344. You have to add back 2344, right? No, I was right. Let me see one thing. Yeah, that is billions. I'm sorry. So it's 8.94 billion. They had 421 million in operating in interest expense, and their earnings would be 8.9 billion dollars, and their net earnings would be 6.9 billion dollars. And then you could see on a per share basis what it looks like. So, and then you could read their 10K, which is the actual 10K. But that's how you would do that. This is how you look at Target. Now, another way we can look at Target, we can go to something like MSN Money. And we can go here. It's a big company. I mean, it's $100 billion in sales. It's a big company, right? But let's look it up. And here it is, $152 million last sale. The market cap is $70 billion, which makes sense because they're making probably like $10 billion a year. So it's trading at 7 times revenue. It's a buy. They've been doing a decent job. They were their competitors. And let's go to their financials. And their revenue here this year is 107 billion. So it's gone down a bit, but that's the general economy. Go back to 2021, we could see it trended up and then it's gone down a bit. Their cost of goods sold has also gone down a bit because they're selling less product. There's their profits, $29 billion. So on $29 billion, they've got a 150 million market cap, right? They got a $150 million market cap. So on $29 billion of earnings, they've got a $150 market cap, right? I'm sorry, a $70 billion market cap. So it's interesting. It's interesting, right? It's interesting. So there you go. You could also look at this from the perspective of Yahoo Finance. Okay, again, market cap is 70 billion. Beta trades a little more volatile than the market. The PE is 15 times earnings, and earnings are $9.68 a share. So they're making about $10 a share, right? They've got a market cap of $70 billion. Okay. And we'll look at financials. You should see the same numbers again. So they have total revenue of 107. Okay, so that's $107 billion. $107 billion. $77 billion in revenue and cost of goods sold. Okay. And so there's a lot of information here. You could use any information you want. Look at the price of crude oil, $68. That's why you're seeing that effect at the pump. And you could just pan through these and look at these. All right, so that's what you're going to do. You're going to give me a basic snapshot of you're going to give me a basic snapshot of Target and just fill out, do it in APA form. It shouldn't be too difficult for you. It really shouldn't be. All right, so let's look at the rest of this week. And remember, balance sheet, that's the key. So you got your income statement that we just went over. You got your statement of retained earnings, which is going to be small. And if you look at my videos, I address that. That's going to be the number you keep in the company. After you've earned your profits, after taxes, retained earnings, you could do one or two things with it. You could either pay dividends back to your shareholders or give them back some of their money, or you can plow it back into the company to earn money, which is what we want to see in most companies. If a company is doing well, we'd rather than plow the money back. Years ago, Apple did not pay a dividend. And the reason why it didn't pay a dividend is it was doing so well that Apple, that the shareholders were saying, listen, we don't want our money back. We gave you all your money because you keep coming up with good ideas and making us money. So that's how it worked for Apple. But the income statement, the statement of retained, but then Apple eventually instituted a dividend because certain pension funds cannot own stocks without dividends. And the complaint from government was different pension funds, different states, governors, people like that who ultimately administer pension funds. The argument was, you're killing us here because Apple's such a good stock, and if you don't pay a dividend, we can't include it in our pension funds. And then they paid a small dividend. Balance sheet is what you own. Remember, we went over this last week, minus what you owe, which is what you're worth. And then the cash flow statement adjusts all of these numbers for actual cash, right? So you have revenue, expenses, and net income. In retained earnings, you got where you started, plus whatever you got in addition, minus your dividends, and that equals your new retained earnings. So where you started on retained earnings, and companies need to have retained earnings, because when they have retained earnings, they have money they can plow back into new projects. They don't have to go out and raise money, just like any business, right? Right? You need that. You have to really get that, because, in many companies, we want to see, what we definitely want to see is that companies will retain it, plow back money into earnings, continue to do well. That is such an important element of how we invest. It's such an important element of how companies should invest. Like any company, even your own company, you make money. Think about Walt Disney, how it grew. He made money and he plowed it back into new projects. Always did that. Started with animation, plowed it into Disney World, plowed it into Disneyland, plowed it into Disney World, and the rest is history, right? Balance sheet tells us what we own, all the assets. We went over that. Watch the videos again. Minus what we owe, which is what we're worth. And then finally, we reconcile back the cash using operating activity. So we'll add back things like depreciation because it's a non-cash expense. And then we do financing and operating activities. Let's say we have accounts receivable. Let's say we made $50 million, but we have $10 million in accounts receivable. We have to actually subtract that, because even though it shows up as income for us, we haven't collected the money yet. So think about that. The depreciation is non-cash expense, so we add it back. Accounts receivable is money we lend to make revenues, so it shows more revenue, but it's not actual cash, so we subtract that. And that's what you do in operating activities. Then investing activities become things like, if you issue new bonds, that's more cash in your bank. It's like if you pay off a credit card, it comes out of your cash as an item. So it lowers your cash that year. Even though you made money on your W-2, you might take in some of that money on your family balance sheet and pay down a loan, a HELOC, or a home equity, or a credit card. Well, that would be a negative to cash. Even though you cleaned up your balance sheet, you had to use cash. But then maybe in that same year, maybe you cleaned up a $20,000 home equity loan, but you took out $5,000 in a car loan. That's positive cash, or positive on your assets. So you have to make those adjustments, because sometimes we just want to see the cash that went in and out of a firm. And there's so many things that go into the balance sheet and the income statement that are non-cash that we have to adjust for that. And finally, that would be financing activities. Now, if we put in new investments, like we built a new building or we bought trucks, that would be a negative to cash, even though we increased our assets and we're going to make more money with those things. Same thing with your personal balance sheet. You have your income and your expenses from your W-2 or however you work if you have a business. Then you have financing. You might have closed on a home equity. You might have taken on more income. You might take on more cash with a home equity that you're going to use for your house. But then again, you might have paid off a credit card, so that was a negative to cash. It's not a negative to the firm, but it adjusts for cash. And then once I put on and then with the investment, I might put in a new kitchen with that home equity, which increases my balance sheet, but was a negative to cash. And that's how you reconcile these cash flows, okay? And to produce a financial statement, right, you actually have to put together your revenues, take away your operating expenses, that's your total expense. And then here would be your statement of changes in equity. You start with stock. Maybe you issued new stock, which is rare. Now you're up to 4,000. Usually once you start selling stock in the beginning, that's when you sell it. Then you take your new income, because that's equity. Take away dividends you paid, because it's money you came out of your equity. And then you got your ending retained earnings, 13. And then you just did it. And you can download these, right, if you want to save these. And then your balance sheet shows you on the asset side your most liquid assets, what you own, right, down to your least liquid assets like land, and then what you owe, accounts payable, unearned revenue, and then the rest is your equity. And notice your equity, 24,000, 17 is your equity, and it has to match that number. Right, it has to match that number. If 15,000 is your income, notice it shows right up over here. So that's how these balance sheets, income is very mechanical, and they have to match out. And then this is your cash flow. You have 10,000 you made in operating activities. Take away 4 because you invested in new products. Take away 2 because maybe you took on new loans that were more than the cash you brought in. And then your net change in cash. There's your beginning balance sheet. When you net these things out, 10 minus 6 is 4, plus 4 is 8, plus 1. Wait a minute. 10 is where you started. When you minus 6, you're down to 4. And that's your net change. Add 1,000 where you started, and you got 5,000. And then finally, you could see this in your income statement. And that's it. Not difficult, but you have to really take it from the professor. You have to do it in a way where it's mechanical. So it's like math. Let's watch this. You just do this. So salaries payable. So you would see that something like fees earned would be on. Let's take a look. How do they do this? How this works. For some reason, it's not selecting for me. Well, you have to slide it. You can. Oh, here we go. Accounts payable. Go on your balance sheet. Your fees earned on your income statement. Salaries payable. There's a balance sheet item. So you just go through it, and that's how you would finish it. Okay. So balance sheet is your keyword this week. Okay, balance sheet is your keyword this week. Any questions on anything? My friends here that are here. Any questions? Any questions? All right. Well, have a good day. Balance sheet is the key word. And then let me know if you need anything. You know how to reach me. Contact me with anything you need. I'm just answering a student.